Good morning and welcome to today's AOD UTP lesson. This is your host and presenter Jesus Reyes, and we are broadcasting live from sunny and 75 degrees Miami. If you could kindly confirm sound and video before we begin to make sure that everything is working okay. Excellent. Thank you very much, Jeffrey. Thank you very much, Doug, for the confirmation on sound and video. Today we will be talking about consolidation. Carl, hello again, my friend, and welcome. So to get set for that, if you're already logged into education.markettraders, please under featured courses, a shortcut would be clicking on Ultimate Traders package. Then under the Wealth and Freedom Experience live event, which will be taking place today and tomorrow if you're interested, click on the download, on the manual for downloads, and then under the table of contents, let's look for consolidation, and you'll find it at page 96, which if you use the PDF file should be about 101. You need to rub it in, the sunny and warm. It is warm. It is. And it is sunny, I'm sorry. Yeah, Montreal is not that much of a weather right now, right? Not very similar to this one. So let's do this. I'll give you guys a moment to get to this page. Please let me know once you're there, and we'll continue with the session of today. Okay, thank you for the confirmation, Jeff. And Doug, you're already there as well, okay. A couple of more confirming and we'll continue. Confirm that you're on page 101 of the UTP manual, please. We'll be talking about consolidation, as you can see on my chart. Okay, sound working okay? Yes, good. Okay, so what we were talking about, sideways movement. We know that the market moves forming waves, waving up, forming higher highs and higher lows in an uptrend, or down, forming lower lows and lower highs in a downtrend. Now, there will be times where the market starts to move or finds itself bound between set levels of support and resistance. Now, this sideways movement or bracketing or pennanting is known as consolidation. There are four major forms of consolidation, which we will be addressing today. We have small consolidation that takes place on time frames that go from the 15-minute up to the 2-hour. We have large consolidation which takes place on time frames of 4 hours and larger. And we have pivot points which appear on all time frames, but will be most effective to trade when identified on the larger time frames, such as the 4-hour and above. And we have pennants, which can also be found on all time frames, but will be better to trade, or will report more benefit to us as traders when identified on the larger time frames as well. Now, we will be covering each of these four categories throughout today's session. Now, let's begin with small consolidation. Small consolidation, as we already established, is found on time frames that go from the 15-minute up to the 2-hour. The range of those small consolidation patterns tend to be between 20 and 40 pips. Now, there are reasons why consolidation will form on the lower time frames. So let's talk about those. So reasons why we find or why consolidation will form on the smaller time frame. One of them is when the daily trading range has been fulfilled and or the market enters into the dead zone. So let's talk first about the daily trading range. Daily trading range, or DTR, is the amount of pips that a given currency moves in a day. Okay? Once that movement has been exhausted, the market tends to fall into that small consolidation or starts to pull back. As it falls into something of a, let's say, a resting period or a period to reset in anticipation of a new trading day. Now, remember that the DTR from one pair to the other will vary. You will find pairs with DTRs around 50 pips, and you'll find pairs with DTRs of over 2,000 and 3,000 pips. So that will vary from one pair to the other. Now let's talk about the dead zone. As you all know, the trading day is divided in two zones. We have the active zone, we have the dead zone. During the dead zone, volume tends to fall. The amount of activity that on the market tends to drop, and you will likely see less volume and less directional movement than the one that you'll find during the active zone because of that. So that's another reason that there being less activity, less orders being placed, also rests movement from the market, allowing it to drop into that small consolidation. So that's another reason why we'll find sideways movement in the smaller time frames. DTR has been fulfilled, or the market has entered into the dead zone. The dead zone goes from 12 p.m. to 2 a.m. Eastern Time. Now, if there are any questions along the way, please feel free to type them down, and I'll try to answer them as we go. If by any chance you see it's been a while since you typed it, and I haven't addressed it, please type it in again or copy and paste it again, and I will follow up on it. Yes, yeah. She was scheduled to talk today. Not sure. Was the opening remarks on a summit or something. Another reason why we will find small consolidation, we will find consolidation on the smaller time frames, is when prices have reached a point of equilibrium where there is no more trading volume to move it. Another reason to find consolidation on smaller timeframes will be in anticipation to a major fundamental announcement. Remember that as we close up on the hour of the release of a major fundamental announcement, market participants tend to step away from the market, waiting for the news to come out, to use that news to determine whether they want to buy or sell. So as they step away waiting for that information, volume drops. And as volume drops, the market falls into sideways movement in the smaller time frame, which will eventually be the one that you'll use to trade those fundamental announcements. So that's another reason why we'll find small consolidation on the smaller time frames. Now, major fundamental announcements tend to increase market movement. So the DTR, as a consequence of a major fundamental announcement, can be calculated at 1.5 times the average DTR. So several hours after the market has been affected by a major fundamental announcement, that can provoke the market to move way beyond its average DTR, it falls into a resting period. And that resting period will be evidenced by sideways movement. So here are the 4 reasons why we'll find consolidation on the smaller time frames. DTR has been fulfilled or the market falls into the dead zone, or as we move into the dead zone, the market has reached a point of equilibrium in anticipation of a major fundamental announcement or several hours after a major fundamental announcement has been released, as the market has moved beyond the DTR and falls into that resting period. Yes, that does happen a bit. Now, we know that the market cannot go be in a bullish trend forever. It cannot be in a bearish trend forever, nor can it be continue sideways forever. So how does the market break out of a sideways movement? How does the market put an end to consolidation? I already answered the question. It does so through a breakout. A breakout puts an end to that sideways movement that keeps the market bound. And here's how we see that happen. The market is sideways, holding between resistance and support until it breaks out of that range. As this will regularly happen, the reason for the breakout will regularly be or the moment of the breakout will regularly be preceded by a fundamental announcement, which will likely be the reason why the market breaks out. As a rule, the breakout will generally take place in the same direction the market was before it fell into that sideways movement. So if you were following up ABCDs and the market moves into consolidation, then as it breaks out, there is a higher probability that the market will carry on in the direction that it was before falling into that sideways movement. Okay? Now, what can we as traders do with a breakout? We can trade it following the direction of the breakout. So, if the market breaks out through support, then that could be an indication for me to sell. So if I decide to follow that move and sell it, I should be placing my stop above resistance. Now, what should we keep in mind? Remember that we are taught to plan the trade the plan, and also to use the if-then approach. So what do we need to keep in mind when it comes to breakouts? The market is breaking out from sideways movement from let's say a channel holding resistance and support. If the market breaks out of the channel and I trade it, but then I see it move back in, and it moves back in beyond, and as it moves back in, it goes beyond the middle of the range, there is a high probability that the market will continue going in that direction and will now be bullish. Okay, so using the if-then approach to this situation, you might want to consider using your stop as a stop reverse. That way, if the market effectively reverses and it's now going to go bullish, as it hits the stop, the market will take you out of the selling position, and using the stop reverse will allow you to get in, now buying and following what would be, in this case, the new trend. Now, what do you need to also keep in mind? Equity management. You need to make sure that equity management fits, that you could take that second trade to avoid potentially suffering a double loss. If the stop order is too far away and you can't afford the loss, it is best not to take the trade. Always always listen to the chart. The chart will tell you the majority of the time which direction it wants to go. Okay? So if this happens, then your stop becomes your new entry. That's a stop reverse, stops you from the selling, takes you in buying, and now your stop will be below support. So let's now talk about large consolidation. We've already talked that large consolidation takes place on time frames of 2 hour and of 4 hour, my apologies. Large consolidation takes place on time frames of 4 hour and above. And the trading range when it comes to pips will of course offer more opportunity because you could find anywhere between 1,000 and 2,000 pips in large consolidation ranges. Now, large trading ranges or trading boundaries will be found in the monthly and the weekly charts. When you consider these ranges, like the monthly or the weekly, oh, not what I wanted to do. You will, if you consider this larger time frames, monthly and weekly, you will see, following the historical price movement of a given pair, that the two countries involved in that currency, basically founded on principles of international trade and public policy between them, they establish ranges within which they want to keep their currencies moving. So by taking the example of this Australian dollar traded against the Japanese yen and going as far back as 1993 up to date, you will see that the market has found a movement with a maximum of near the area of the 100 Australian dollars per yen and a low and a historical low around 60. So the market finds support and at near 60 and resistance near 100. And every time it meets one of those, either of those levels, it starts to move to the other one. Now, what does this give you opportunity-wise as a trader? Knowing this, how do you think that this can benefit you as someone who is looking for opportunities in the market? What comes to mind in my case is the plan your trade. Having this information allows us to plan what we should be looking to do. So now I know that if the market has recently visited 100, then I could start looking for bearish opportunities, or should be favoring bearish opportunities towards 60. How long will it take? Not sure. Why? Because look, here it took how many months until it hit? Let's use this one. 67 months. So that's about 5 years and 7 months. But then we had a aggressive drop, and in 1, 2, 3, 4 months it hit support. And then moving back up again, it took 50 months. So you can establish an average and expect the market to be overall bearish for the following 3 years or 5 years. So unless you are planning on trading for less than that time, you should know that you can anticipate the market within 5 years from visiting, or about 5 years from visiting resistance, to be at support. Now, using this monthly consolidation, you can now move to the 2 hour or the daily and start looking for those high prices, to then go to the smaller time frame, to the one that you trade on, and look to identify entry opportunities in that direction. So on larger time frames such as the 4 hour or greater, once you find consolidation, you should consider buying support and selling resistance. Another thing that you can anticipate to happen is to find smaller consolidation ranges within the larger ones. So let's say here you find support, the market is going up, and it falls into consolidation. Now you know to buy support, sell resistance, buy support, sell resistance. But you should also keep in mind that though the market could break out in either direction, you should be expecting it to have a higher possibility or probability of breaking in the direction of the bulls, because that's the direction it was in as it fell into consolidation, and you are coming from support, so you're expecting it to move all the way up to resistance. In the meantime, you can go to a 4 hour, a 2 hour, a 1 hour, and as the market makes its way up here, then you start looking for selling opportunities. As it makes its way down to support, then you start looking for bullish opportunities. Any questions so far? Yes, it shows the market's direction on the larger time frame, on the long term. And if I go to the let's say the Aussie CAD is also one that where we can find this. And here you find that consolidation. Resistance near 105.30 and support near 85, let's say 86. So how much does that represent an opportunity? Going up 1900 pips. So you sold here, made profit. You wait for the next high, you sell again. You wait for the next high, sell again. You wait for the next high, you sell again. And every time the market forms a high, you start looking for selling opportunity. So by doing this, you can look, so basically the idea will be to look for the higher time frames to identify these patterns, and then look to take advantage of that anticipated move by identifying trading opportunities in that direction on the smaller time frame, 15 minute, 1 hour, 2 hour, whichever is of your preference. Now let's talk about Forex pivot points. Let's talk about the pivot points. Now, Forex pivot points are areas where the market creates a price level of support and resistance. So one, it is not it is called a pivot point, but it's an area because its resistance and support are areas. Where the market has found historically both resistance and support at or near that level. So how do you follow up on it? How do you take advantage of this? Once keep in mind that though you may find it on all time frames from the 1 minute all the way up to the monthly, the larger the time frame, the better. The more reliable it will be. So how do you address this? So you identify on the 8-hour, daily, weekly, or monthly time frame a pivot point. Now, if the market is north of that pivot point, as it becomes to move down, getting closer to that pivot point, it becomes in price an area of support, which enables you to start looking, which should invite you to start looking for potential bullish setups. Because if support holds as it has done so in the past, you should anticipate the market to push back up. Now let me see if I can identify one that I can bring to your attention. I think I have one here on the daily. Now here you see this level where the market has found resistance, support, support, resistance, support, support, resistance, 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 and support. So it has acted as both levels of resistance and support. So if you find the market moving from north to south towards it, you should, as it gets close, you should start to look in for buying opportunities, CTL breaks, bullish candlestick formations, and such. If on the other hand the market is below it, then that becomes in price an area of resistance. And as the market closes up on it, you should start looking for selling opportunities. CTL breaks, bearish candlestick formations, reversal patterns, anything that technically allows you to identify a selling opportunity. Now, last but not least, we'll talk about about pennants. Now, again, as pivot points, pennants may be found on all time frames. And we'll talk about why I would suggest to look to identify them on the larger time frames. Basically because of the opportunity that it represents. When we talked about consolidation on larger time frames, you know that you have more pips of opportunity as if you find that same pattern on a 15-minute chart. Now, a pennant begins to form when the market vibrates or bounces between support and resistance. Okay. Now, market prices tends to get tighter when it is in a pennant, as the consolidation range becomes smaller and smaller, and that will tend to lead to the breakout. So on a pennant, you'll see the market bouncing between support and resistance, but that trajectory from resistance to support and back will start to become smaller and smaller until the market reaches the tighter end of that formation, and there it breaks out. We have pennants usually form after there has been a big move on a larger time frame, or when the market breaks out from a fundamental announcement on a smaller time frame. As we already mentioned, you may find them on all time frames, but I think that they offer more better opportunity when identified on the smaller ones. Now, what to do? If you identify a pennant on a larger time frame, let's say we are on the 8-hour, you identify this on the 8-hour or on the daily or anything 4-hour and above, then you, on that larger time frame, you connect those highs of resistance, connect the lows of support, select, right-click, link to the lower time frame. So what do you look to do on that lower time frame? As the market, every time the market visits resistance, then you start looking for selling opportunities, and you keep on selling those lower highs all the way down to support. Once the market makes it down to support, then you reverse direction and you start to look for buying opportunities, and you keep on buying those lower highs, those higher lows, all the way back up to resistance. And you continue to repeat that process until the market breaks out. How do you know you're getting closer to that potential breakout? Well, the smaller, the tighter the market, the movement gets. That's an indication that the market is getting closer to break out and find an end of the end of that pattern. But in the meantime, you make pips, and pips is money. Now, we have we're going to be talking about 4 types of pennants. We have flagpole pennant, which is this one to the left, where the market is moving within a swing. In this case, we have an up AB. The market is moving in a Fibonacci sequence, bouncing off support and resistance trend lines, and that bounce begins to get tighter and tighter until the market breaks out. Now, these flagpole pennants can break out either bullish or bearish. But if we bring our attention back to the point we addressed, where we established that as a rule, the breakout tends to take place in the same direction the market was at the moment it fell into consolidation, then in this case you could anticipate a preference for a bullish breakout. Though, as we already established, it can happen in either direction. Now let's talk about the ascending pennant. The ascending pennant, it takes place when you find the market bouncing between support and resistance, and in that process it's forming higher levels of support or higher lows and equal or similar levels of resistance. Hence the name of ascending pennant. Now, the breakout on these type of formations tend to be bullish. Okay, you see that there is more pressure for the market to continue going up, forming higher lows of support and equal levels of resistance. The same principle applied in the opposite direction will be the case of the descending pennant. The descending pennant takes place when the market creates equal levels of support and lower levels of resistance. The market is forming lower highs and equal or similar lows. Again, this has a higher probability of breaking out bearish. And last but not least, we have the diamond pennant. Now, the diamond pennant takes place as the market starts to bounce between support and resistance, but first on an expansive move. So the range between support, the range of the bounce starts by expanding, and then it starts to contract again. And that's the reason why it takes that form, and that's why it's called a diamond pennant. Now, similar to the flagpole pennant, it could break out either bullish or bearish. However, keep in mind the direction in which the market was moving as it fell into consolidation, and that could give you an idea of the direction of the potential breakout. Now, remember that we talked about the breakouts, and we also talked about trading the breakouts. So if the market breaks out of consolidation of this pennant, you can trade that. You can trade in the direction of the breakout. If it breaks out bullish, you place your stop below support. If it breaks out bearish, you place your stop above resistance. Similar to the scenario that we talked about earlier today, if by any chance the market moves back into the consolidation pattern, in this case into the pennant, there is a high probability that the market will be shifting direction, which means that the new trend could be opposite to the direction in which you are trading. So consider using your stop as a stop reverse. By doing this, if the market effectively shifts direction and takes you out, it will take you out of your initial position and take you in a new one following the new trend. Always, again, plan your trade your plan, establish risk-reward ratios, equity management. Make sure that you could take that second position if that were to happen, to avoid suffering from a double loss. That's it. Are there any questions? Did you find this information useful? If you have any comments, concerns, suggestions, please feel free to send me an email. I'm posting it in the chat box for all of you to have at hand. And if there are no questions, I want to thank you all for joining. I want to thank you all for participating. Much success on the rest of your trading day. Feel free to join me for the last segment of AOD, where I'll talk about the positions that I have opened, closed, and the ones that I might be taking between today and tomorrow. And having said that, I want to thank you all again. Have a great day, and until next time, this is Jesus Reyes signing out.